Welcome, everybody, to this week's edition of Market Insights. I am Steven Sitkowski. Hope you are well, wherever you might be. Let me go ahead and share my screen with you. There we go. All righty. We're up and running. Hope you had a nice weekend. Interesting weekend, to say the least. We're not going to get into all of that. But the market is pretty happy that former President Trump is okay. This presentation is for educational purposes only, not intended as investment advice. I'm not acting in the capacity of an advisor, rather an educator, sharing my personal observations and thoughts about the market. So what to watch this week? Well, we had the Empire State Manufacturing Survey come out, a little more negative than expected. Clearly, we are seeing a slowdown in the economy. Chairman Powell speaking today and has reiterated the fact that he does not need, and that the Fed does not need, for inflation to hit 2% before a cut in rates. Good thing, because that's not going to happen for at least another year. Some more Fed speak, Mary Daly. Tomorrow, we have U.S. retail sales numbers coming out. I don't think any of the rest of that is a market mover, frankly. On Wednesday, the Beige Book comes out. So that's the Fed's assessment of the economy and a report thereon. Thursday, as always, we have initial jobless claims expected to come in 228,000. That seems a little light to me. We'll see how that goes. Last week it was 222,000. Anything above 228, the market would look at and go, okay, well, labor market is slowing down, hence greater likelihood for the Fed to cut. We have the Philly Fed Manufacturing Survey and U.S. leading economic indicators, which have been negative for about 2 years now. Then a little more Fed speak on Friday. So I think Thursday is going to be the big day in terms of potential market move. Last week's heat map. So there was some rotation out of some of the tech names into some of the more defensive names. NVIDIA beat the trend, so did Apple, AMD, Intel. Microsoft down 3%. Look at Meta, took a 7.5% hit last week. Year to date, it's been all sunshine for the most part. NVIDIA up 194%, Microsoft 34%, Broadcom 91%. Well, there have been lots of companies up more than 50%. AMD 58%, Qualcomm 70%, Micron Technologies 109%, Google, now Alphabet 56%, Meta 61%, Amazon 48%. Look at Lilly with their weight loss drug, 115%. Been a lot of money to be made out there. This is how the sectors have performed. So for the last year, the S&P is up 25.56%, tech up 46%, communication 41%, financials 23%, and everything else drops off pretty dramatically. So the only two sectors that are beating the S&P averages, tech and communications. The big winners last week, Enphase up 22%. Corning, that's not a very sexy name to be up 18%. And then a bunch of building stocks because of the anticipation of lower rates. Builders First Source up 15%. Mohawk, D.R. Horton, CarMax, there's Lennar, Pulte. So anything that benefits from lower interest rates went up. Prices are retreating a bit. You can see, look what's going on over month with inflation. Actually had Supercore was a negative number, which was great. Need to get the cost of living down for people. Negative economic surprises. Look at that. Not good, but that's what the Fed was looking for. Kind of a strange relationship between negative economic surprises and the S&P. Why is that? Because negative economic surprises mean a rate cut, which is good for the stock market, and the market is always looking forward. Traders are betting on IWM. This is the Russell 2000. Look at the call option activity. By the way, I own some of that. So yeah, we definitely saw a breakout in the Russell. Future of earnings looks bright. Everything looks really nice. So this is the share of the top 10 companies' earnings and share of the top 10 companies according to market cap. So the big boys moving higher. Not a ton of participation in the S&P. You know, when we look at the percentage of stocks that are outperforming the averages, it's down here around 22, 23%. So you've got a whole bunch that are falling behind. This is definitely a stock picker's market. PE ratios are elevated. The average PE ratio, that's the price per share divided by the earnings per share on the Magnificent Seven, like 53. Equal weight S&P is about 20. S&P overall, 26. This is the behavior of the market in election years. So generally get a run up, then we start getting closer to the election, we get some choppiness. Then after the election, no matter who wins, everybody generally feels pretty good because they're being pumped with promises. Market sentiment, we are now in the greed stage, which is where we should be. I mean, all of the stoplights right now are basically flashing green. Election year, Fed's going to pause. What more could you be looking for? Now, given that, look what's happened with consumer sentiment. The problem with a fall off in consumer sentiment generally means a fall off in spending. So it'd be nice if consumers felt better. Probabilities now of a rate cut in September, 92.28%. So I think September is the month. I've been telling all of you that I didn't expect a rate cut in November. I just thought it wouldn't look good to have an election and a rate cut 2 days later. Plus, the Fed wants their moment in the sun. You don't get it right after an election. So it looks like it's going to happen. Earnings this week. What do we got? PNC, I just paid off a mortgage on PNC. United Healthcare, this is Tuesdays. The Wednesday, Discover, they'll tell us a bit about the economy. Thursday, KeyBank, I was just in a KeyBank. Netflix, that's after hours. That could be significant. Then Friday, American Express, Schlumberger, both announce. So we are getting in the midst of earnings season. On our trade ideas of the week that we put out for Inner Circle folks, let me show you the latest and greatest on that. Number of trades closed this year, 74. Average return per trade, 18.9%. Average holding period, 19.2 days. So in our closed trades, we're averaging almost 1% per day. Take a look at the charts. All right, let's look at the SPX. This is a proxy for the S&P 500, and everything looks pretty lovely. We spent almost the entire 6 months above the 50-day moving average. That's this yellow line. And we're definitely bullish. Now, the one little consideration, notice these long wicks. So it means the market's gotten higher and then kind of sold off toward the end of the day. So we'll be keeping an eye on that for sure. It's indicative of a bit of indecision, but overall, can't argue with the chart. It looks great. It's bullish. How about on the triple Qs? So we had that day of rotation where these dropped, and now they're trying to make a comeback. But again, look at these long wicks. Generally, a mini red flag. Let's call it that. And then IWM, we were talking about this. Look at how it's taken off. Isn't that lovely? So we're finally getting participation from small cap, and that's predominantly due to the fact that we're expecting lower interest rates. And these companies tend to be more heavily financed, whereas Apple doesn't need to borrow money from anybody, right? They make money loaning their money. But some of these smaller cap companies, not the case, but everything looks great. Bullish, bullish, bullish. All right. Well, thanks for being with me. I'll be back with you again next week. Until then, be safe, be blessed, and bye for now.